Stephen Maijoor has been a loyal and strong friend of this conference throughout. This time in his role on the board of the Dutch Central Bank. And I think it was very nice, Stephen, we had Petra a bit earlier looking at the supervisory challenges of new technologies from an insurance perspective. And you would like to talk a little bit about financial stability and how technology interacts with the mandate of central banks in the area of financial stability. I think it fits perfectly together. Thanks so much for being with us. It's a real pleasure.
Thank you very much, Nick, and very good to be again at the conference. As we exchanged last year, the conference in 2020 was the last one that I went to physically just before the COVID pandemic started, and it was good to hear that you just said that the expectation is, and let's hope that indeed that becomes true, is that next year we come physically together again. Ladies and gentlemen, it is great to be here again at the Afore Conference 2025. Yes, you heard me correctly. It is 2025, and it's already the third physical conference since the end of the COVID pandemic a few years ago. You may have come here by car, and as you drove on the highway, your semi-autonomous vehicles was sending real-time data on your driving style to Google Insurance. Your insurance premium is adjusted accordingly every month, and the underwriting risk is sold to a white label insurance company. And since you've had this car for almost 3 years now, you're soon expecting the first ads on your smartphone for the car models that your eyes have been scanning over the past few months. They will be accompanied by several personalized financing offers from banks and fintechs, based on your credit score data collected from a host of e-commerce and other data sources. Since the exchange rate has been rather favorable lately, it may be attractive to use the stablecoin savings you hold in your e-wallet attached to your favorite big tech platform to make the purchase. Sounds like science fiction? I wouldn't be so sure. Some parts of this scenario are already becoming reality as we speak. And although it's notoriously difficult to make predictions about the future, technological developments are going so fast that it may be wise not to dismiss this or any other scenario up front. Now, personally, my tech savviness has its limits. My son is friendly enough to remind me when I play FIFA with him on the PlayStation. But believe me, I'm just as excited as you are about the tech revolution, also as a financial supervisor. Because let's face it, fintech may offer large benefits to consumers in terms of new services, ease of use, inclusiveness, and costs. And over the years, as a conduct supervisor at ESMA, and now as a prudential supervisor at the Dutch Central Bank, I've seen quite a lot of innovations. And I see innovation as a good thing. Throughout history, financial innovation has often been a driver of economic growth and prosperity. And that is why in a market economy, the challenge for financial supervisors has always been to adapt to innovation, so that we can benefit from the good while keeping in check the bad. Nothing new, you might say. But still, amid all the excitement, I understand the nervousness of financial supervisors about fintech. Because right behind the high-tech picture I just painted for you, all kinds of new risks and uncertainties are looming, many of which go to the very heart of our mandate, which is to safeguard the stability of the financial system. For example, will the well-known market power of big techs increase concentration risks in finance? And as the value chain gets sliced between various parties, is it still clear who bears the ultimate financial risk? And how can we be certain it is still managed and priced adequately? And what if a major incident relating to data privacy triggers a loss of trust in a big tech? These are just a few questions about this important matter. There are many more, and some have no doubt already been mentioned by previous speakers. But perhaps the most fundamental question is this. In a system where so many new previously non-financial players are becoming instrumental in offering financial services, how are we, as financial supervisors, going to ensure that the financial system remains robust and consumers stay safe? How can we make sure that we continue to have the right mandate and effective instruments to ensure that outcome? Let's take, for example, the rise of platforms. Banking and insurance are increasingly offered as a service on a platform that offers all kinds of other products and services. Platforms are often active across various sectors, and here financial regulators are not the only, nor even the primary regulator as they used to be. And this makes it more complicated for them to have the full picture of the activities and risks of the entire platform. It also raises questions about the extent to which financial regulators should look at platforms' non-financial activities. And next to the issue of having the full risk picture, financial supervisors will have to act more and more on the basis of what I call horizontal rules and regulations, a matter that was also just discussed by the previous speaker. Rules that are not specifically designed for the financial sector, but have a much broader application. Like, for example, on data privacy and artificial intelligence. But financial policymakers and regulators do not have a seat at the table where and when these rules are set. Blockchain-based platforms pose even more profound challenges. These are often a great deal more decentralized than traditional financial intermediaries. What is the supervised entity here? And next to the rise of platforms, another important development is stablecoin. The use of private stablecoins is still limited, partly because of their risks to users. But stablecoins also have features that could make them attractive, for example, in countries with weaker institutions and unstable national currencies, and for cross-border payments. As soon as the conditions are right, things could go very fast. Based on the experience with dollarization in developing countries, we know there is a tipping point beyond which adoption of a new currency increases exponentially. And without regulation, such a steep rise in the use of private stablecoins could pose a threat to financial stability. Given the nature of this new wave of innovation, the guardians of the financial system will have to be innovative themselves and redesign regulation and reorganize supervision. And I think cooperation is key here. Since the tech revolution crosses both geographical and sectoral borders, regulators and supervisors from various jurisdictions, remits, and sectors will have to join forces. Now again, you might say this is not new. Regulation and supervision have always followed the changing structure of finance. In the 1980s, regulators responded to the internationalization of banking by forging an international agreement on minimum capital requirements, the so-called Basel Accords. And in the 1990s, the rise of financial conglomerates was followed by regulations on consolidated solvency and the cross-sectoral merging of financial supervisors. But at the same time, these examples immediately make clear what the scale of the current challenge is. Because this time, change does not take place across one, but across multiple dimensions. National versus international, financial versus non-financial, entities versus activities. And that all at the same time. This is not Basel III, this is Basel to the power of 3. So whatever we do, we would better start by ordering a couple of very big meeting tables. Or, in the spirit of this conference, tick the large gallery view. So how to proceed? Well, let's look at regulation first. As we have seen, both platforms and new technologies do not operate exclusively in the financial sector, but do play an increasingly important role there. I think we should recognize, therefore, that horizontal regulation is often the best way to regulate them. For instance, the European Services Act and Digital Market Act are important tools for regulating platforms. And similarly, the expanding automated data access cannot just be addressed within the confines of the financial sector. Increasingly, Non-financial data, like for instance, the data your car produced on your way to this conference, are key to innovation in the financial sector. Developing a framework for data access must therefore be done at the horizontal level. But that means that financial policymakers do have to have a seat at the table when these regulations are being developed. This requires a shift in the thinking of both financial and non-financial regulators. More horizontal cooperation needs to be mirrored by more international cooperation. For example, the rise of platforms comes with the risk of regulatory arbitrage, far more so than was the case in traditional finance. International consistency is needed in how platforms are regulated, for instance, in the regulatory approaches to big techs. Another key example is stablecoins, where we've seen different jurisdictions moving towards regulation and where consistency is especially needed. This will only become more important as decentralized finance grows. And given the pace of developments, it might be wise to build flexibility into the regulatory framework. This can be done by adopting a more principle-based regime at the level of primary legislation, while delegating more to the European supervisory authorities. And I know very well that there are legal considerations making it difficult to achieve this. But we should push the boundaries here to ensure that the regulations of fintech are as effective as possible. At the global level, the FSB has a key role in ensuring an overall consistent approach and for bringing all the necessary expertise together. And next to regulation, the sector's changing structure also calls for us to rethink supervision. First, I believe we should look more towards the EU level and where necessary move financial supervisory tasks related to fintech to the ESAs, the European supervisory authorities. A good example of this is MiCAR. Moreover, the remit of financial supervisors may have to be expanded so they can continue overseeing key parties in the financial value chain. The DORA regulation makes this possible by introducing financial oversight of non-financial critical third-party providers. And to make that oversight as powerful and efficient as possible, I do believe it should be properly resourced and as much as possible centralized at one of the ESAs. In addition, as the lines between financial and other sectors blur, we need cooperation arrangements with other types of supervisors. These can take different shapes depending on the issues at hand. In the Netherlands, for example, supervision of payment service providers under the PSD2 directive is conducted by two financial supervisors jointly with the data protection and competition authorities. In the future, we may even have to move towards joint centralized supervision in newly formed entities. And by centralized, I mean not only across financial subsectors, but also across the financial and the non-financial sectors. That may be the case, for example, for the supervision of cloud providers. In order to prevent fragmentation and duplication in cloud supervision, we should consider a new horizontal cloud supervisor that would have a mandate regarding the resilience of cloud providers and the compliance with privacy rules. The board of this horizontal cloud supervisor could consist of representatives of the ESAs, the European Data Protection Board, the European Union Agency for Cybersecurity, and possibly other relevant supervisors. This, of course, will not happen overnight. Over the next few years, we have to work to make cloud supervision under DORA as effective as possible. But I think the centralization option is something to keep in mind when we will review the DORA framework in a few years' time. As the financial sector transforms, the stakes and gains from cooperation are high. As financial regulators and supervisors, we have a responsibility to make sure that we can continue to deliver on our mandate to safeguard financial stability. We want no holes in the global financial safety net, however much it gets stretched and shaped and reshaped. Let's live up to that responsibility and take the first steps now so that people can drive to the A4 conference or elsewhere 3 years from now, knowing that their money in whatever shape is safe. And that as finance proceeds further into the digital age, we continue to have a stable and efficient financial system that works for all. Thank you very much for your attention.
Thank you very much, Stephen. You did give me a short heart attack there that I thought I'd slept through 3 years and we were suddenly in 2025. But then I felt relieved that I had 3 further conferences behind me successfully. But I like the way you look at things. I think you are happy to take 1 or 2 questions. And maybe let me start, and please remind the audience as well. Your speech is very interesting because I think it builds very much on a very interesting paper the Dutch Central Bank published. Well, I read the Dutch version, not showing off, sometime before the summer, but I think you published an English version after the summer. I can only recommend that paper to the audience. One of the things, though, that your partner authority, the AFM, the conduct regulator, proposed is also potentially supervising data aggregators, a new function, a new activity. You mentioned cloud, but actually in many ways data aggregators might become more important. What's your view on that? And on kind of taking that as an example, do you see other type of activities in the digital space that should have their own licensing regime or their own oversight regime?
Well, thank you, Nick. And obviously there was no intention to give you a heart attack. And I would assume that indeed in 2025, the A4 conference will still continue. And I think the key point here is what we are seeing, obviously, is that the stability of the financial system, the well-functioning of the financial system is getting more and more reliant on providers, on activities, on companies, entities outside of the financial sphere, outside of the financial markets, outside of the financial system, and we're trying to struggle to cope with that issue. And normally the way to do that, obviously, is to supervise and regulate them through the financial sector. And I think DORA is very innovative by giving a direct link between financial supervisors and non-financial parties that are relevant to the financial sector. And I think the key issue here is what is the relevance of that sector, of that entity for the financial sector. And so when data aggregators become so important that they become a concern from a financial stability perspective, then you need to make that assessment. Would it be proper to bring them into and relevant to financial supervision? Obviously, data aggregation, the AFM looks mainly from a conduct perspective. We're looking on a stability prudential perspective. And so for me, the key rule would be here that once a entity outside of the financial sector, a non-financial entity, becomes relevant to, let's say, the stability of the financial sector, at that point in time, it also becomes relevant in terms of regulating it and supervising it from a financial perspective.
Maybe building on that, we had an interesting conversation with Burkhard Balz yesterday, very specific on payments, but he made a point that I think is very interesting, which is in a way that central banks already have a significant mandate to ensure financial stability. It's at the core of their mandate. And then also financial payment systems and various other functions. And so the PISA framework is being reviewed and has been reviewed to bring direct oversight by the central banks over certain payment systems and payment arrangers. Is this a model for other players? Because we could apply to other financial infrastructures potentially. Do we need a regulatory framework, or could not the central banks in many cases just take that responsibility themselves, at least for the financial stability element? I take your point about cross-sector cooperation, but when it comes core to financial stability.
Well, I think obviously the central banks have their oversight role vis-a-vis infrastructures, I think from, let's say, the supervisory angle, typically supervision is more intrusive and has additional powers compared to, let's say, oversight. And once, let's say, a non-financial player becomes relevant from a prudential perspective, I think then you would like to have these more, targeted, more effective instruments, more micro instruments to conduct your supervision. If we're talking here about cloud providers, this really concerns, their governance. How is their continuity ensured, and that requires the typical supervisory powers that you also have vis-a-vis financial entities.
Looking at it maybe slightly differently, I take your point on that. If we look at the value chain, what you often see is not a fintech versus financial institutions debate that we seem to have had 5 years ago when we had this conference, but it's a very collaborative structure in which you still have a regulated entity somewhere in that group, so to speak, that is the outward-facing entity, but a lot of the distribution, marketing, or other activities, outsourcing activities, are done by other parts, either of the same group or by other parties. To what extent can you still rely, or turn differently, couldn't you rely sufficiently on the financial services regulated entity as your entry point into that structure, and really enforce things through that? And take DORA as an example. The ultimate enforcement over cloud operators in DORA is through the supervisory process vis-a-vis the financial institution that is licensed. The oversight framework is an additional convenient structure, but you still have the supervisory structure. To what extent are you not comfortable enough to just go to the regulated entity and really manage the whole framework through those entities?
I think there are two issues here, Nick. First of all, how these cooperation arrangements will develop in the future. I think that that is a dynamic process. And for example, we see in other parts of the world, what we have seen in Asia is that the big techs themselves were applying for the license in insurance, applying for the license in banking. The current mainstream model in Europe is that is not happening, but we cannot rule out that these cooperation arrangements might change as these markets are developing. And I think we need to have instruments that are robust also when these developments take place. I think one of the problems with the doing this all through the financial entities is that these financial entities themselves, you might not have sufficient supervisory effectiveness. And I think one other element, which I also mentioned in the speech, is the high level of concentration. The big tech has brought us a lot as consumers and benefits in our daily lives. I think where there's one main concern, obviously, is around concentration. That is one of the dominant concerns around big techs. And addressing these type of issues purely through the supervised entities, I think raises questions around effectiveness. And there I would say that therefore it's important that we also over time think about other models where the relationship becomes more direct. I think DORA is already a substantive step forward where there's kind of a mix where the information is coming from the big techs in a direct way, but some of the enforcement needs to go through the supervised entities and the national supervisors. I think that is a first step, but obviously that will continue to develop. And I think to be effective there, also direct relationship vis-a-vis non-financial entities will be important.
Thank you very much. I mean, another approach that's been taken, and maybe it's just come to the same question from a different way, is looking at MiCA, for example. In MiCA, the approach, or in the benchmark regulation, and or in the Alternative Investment Fund Directive, there's a philosophy that once regulated financial institutions do something, that potentially brings that activity into the financial services realm. So whether that is a collective investment in horses or forestries, as the Alternative Investment Fund Directive sets out, or the creation of new benchmark administrators, because financial institutions use a new benchmark, and in MiCA they use some form of a crypto as an exchange. Again, it's at the moment a vehicle that builds through the regulatory framework. And maybe I think what I'm trying to get to is, and I asked Maijoor McGuinness, the Commissioner, the same question, is our regulatory framework really still up for to equality, or do we really need to take a quantum leap forward and fundamentally rethink the whole regulatory framework in the EU, where home and host issues become blurred, retail wholesale becomes blurred, different activities become blurred, different distribution methods become blurred, because that's how we kind of created our little boxes, our Pac-Man, as I call it, and suddenly now we have a new technological revolution and we have to play FIFA. So, how do you see that evolve?
Well, I think that is partly a evolutionary development, and maybe to give the example here, you just made the point, shouldn't we regulate, for example, cloud providers through financial entities? To some extent, we could have asked the same questions around credit rating agencies, in the sense, should we regulate rating through the users of them in the financial system? But at one point in time, we got to the realization they are so important and so fundamental for the functioning of the financial sector, we need to start regulating them directly and supervise them directly. And so the fact that we in an evolutionary way, with further developments, we decide to bring more entities under supervision because these entities appear to be so important for the financial sector. I think we have seen that more in the past. I think the element which is slightly different here, of course, is that it goes from financial to non-financial, but to some extent that is more of a definitional issue. The fact that there are such entities that are so important for the financial system in itself, I think, gives an argument that you need to look at that from a regulatory and a supervisory perspective.
Thank you so much, Stephen, for your time. I think I'm looking forward to the implementation of DORA, because I think that's where you will see the oversight body actually for the first time having to decide when is a player sufficiently significant in an ICT context that it should be brought under the oversight framework. And I think that would be interesting, because I think a payment regulator will have a different view to an insurance regulator, to a banking regulator, securities markets regulator. We'll see. But thank you so much for being with us.
Thank you very much, Nick.
And yes, hopefully to see you in person next year. And yes, hopefully we will continue a few years, because we certainly have enough subject matter to discuss.
Absolutely. Thank you very much, Nick.
Thanks, Stephen. All the best.